Hi everyone, and we are now on our video number 2. Our objectives for this video are: number 1, to understand the debits versus credits in accounting, and number 2, we're also going to show you the accounting equation. And this is Anna's Excel and Accounting video number 2, Road to Accounting series. Let's go on and take a ride and learn with us. So first off, we'd like to review our video number 1. The video number 1 is just mostly about the definition of accounting. So what is accounting? So I took this definition from Merriam-Webster Dictionary. Accounting is the system of recording and summarizing business and financial transactions and analyzing, verifying, and reporting the results. So based on this definition, we'll go ahead and break out what those mean. So when it says system, the system refers to the accounting software used to record, summarize, analyze, verify, and report the results of operations. Examples of this accounting softwares are SAP, Microsoft D365, Oracle, QuickBooks, Peachtree, and JD Edwards, among others. Each industry has its own specific kind of software. So there could be a banking software. They use a different kind of software for their own accounting system. Retail stores too, because they have a lot of inventory. So it all depends on the industry where you are working. So when we say analyze and verify, that includes analyzing and verifying the transactions first. So the example that I have in here, which is not limited to just accounts payable and sales invoice. Accounts payable is the department that mostly receives the invoices that need to be paid. And when they receive the invoice, their process is normally they analyze the invoice. They have to make sure that the invoice is legal or it's a legitimate invoice that needs to be paid. So their process usually is they send it to the manager of that department who is responsible for that invoice. So that's how they will verify that the invoice is a legitimate invoice that really needs to be paid by the company. Once that manager approves it, the manager, some companies, they'll have the manager also code the invoice, meaning the GL or general ledger code is provided by the manager because they know exactly what to use. They know where the budget goes, and they should also know based on historical GL code that was used for that GL. So once the invoice is approved and the GL code is provided by the manager, they send it back to accounts payable department, and then accounts payable department will then take a look at the invoice again to make sure that the approvals are there, the GL code is there. In the real world though, if it's not a two manual kind of industry or company is what I mean, they have an accounts payable system as well. An example of that, what we use in our company and other companies I've worked for, is Concur. So they don't really have the paper invoice going from accounts payable anymore to the manager, but the manager now submits the invoice through Concur, and all the approval process goes into Concur. So it's no longer based on a paper invoice that goes around the office from one desk to another. So in Concur, they have the ability to upload the invoice, view it from there, review it from that software or system, and approve it from there. And once they're done, it's also sent to accounts payable department ready to be paid through Concur. And that's how accounting department or AP department will then process and pay the invoice. So that's one example of an activity or a transaction in accounting where analyzing and verifying is used. Another one is a sales invoice. So when 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 an item or a merchandise or services are sold, an invoice is sent to the customer. So that's another form that triggers analyzing and verifying, and a transaction that needs to be recorded. So we'll move on to our next one. Next is recording. So once all of that, say accounts payable invoice has been approved, that gets recorded, and I've already said an example is through Concur software or other kinds of accounting or accounts payable software. The recording happens then into the system because it's an automated system or process these days in accounting. And then once that's done, we go to summarizing. Recorded transactions are summarized in a general journal, which flows to the general ledger, or in a general ledger, you'll see T accounts, which I'm going to be showing you in a few minutes. And then it goes to the trial balance. Once that's all of that is done, the next segment of our accounting definition is reporting. So this is the main reason why we do all of these processes, right? From analyzing and verifying, recording it, and summarizing it. The end of this whole process is to make sure we can report those information. So reporting then is done by the process of creating or generating the financial statements. And examples of the financial statements that we have is the balance sheet, the income statement, and the statement of cash flow. And these reports or financial statements are then reported to either an internal user or an external user. Internal user could be your HR department. It could be your own accounting department, finance department when they're dealing with variance analysis, your budget versus the actuals, or if they're dealing with cost accounting. So those are our internal users. Examples of our external users are, let's say, IRS. When we submit our taxes, tax information, they need our financial statements as well, right? Or a bank. If you have a loan with the bank, you've got the bank covenants. With the bank covenants, you have to submit your financial statements. Those are examples of external users. So that's a quick review of our first video, video number 1, mostly on the definition of accounting. Now we're going to move on for our objectives for this video number 2. The accounting equation. Let's go ahead and discuss what is the accounting equation. So when we say accounting equation, this refers mostly to the balance sheet. And what is that accounting equation that refers to the balance sheet? It is asset is equal to liabilities for stockholders' equity. So if you have already seen a balance sheet, you'll have an idea what this is all about. For this video, we are not going to be presenting a formal balance sheet presentation, but we're just going to go through the basics for now. So we're going to define the equation, asset is equal to liabilities for stockholders' equity for now. So what's in our assets? Let's take a look at the examples of what GL codes or GL accounts belong to the asset account, or the asset category. So we've got cash, accounts receivable, inventory, prepaid, and other assets, property and equipment. And as you can see right there on top, I also included a normal balance. The normal balance of an asset account is a debit. When we talk about normal balance, always think about increases. So I have a note at the bottom here that says normal balance code is useful in journal entry. Remember, increase. So if the activity is increasing the balance in asset, then debit the asset account. If it will increase liability, then credit the liability account. A decrease in balance will then credit an asset account and will debit the liability or stockholders' equity account. The GL balances should follow the normal balance rule. So this is very important. I have to stress this all the time to my students. It's very important that we know the basics, which is the normal balances of account. If you don't know the normal balances of account, it's going to be difficult to prepare your journal entries. And it's going to be difficult as well to prepare reconciliations and account analysis. So the first thing we got to remember, for an asset, every time we increase an asset because we're buying new assets, or if we receive a payment from our customer, we're increasing the asset cash account, we always have to debit those accounts when we are going to create the journal entry. Right here, normal balance is a debit. So these are the assets of the company. Again, examples that we have is cash, accounts receivable, inventory, prepaid, and other assets, property and equipment. And we're going to go through the meaning of how these accounts are used later on. Maybe in our video, the third video or the fourth video, we could do that. We're going to move on to liabilities. So what are liabilities? The liabilities is anything that the company owes another company or another organization. The normal balance of liability account is a credit. So every time we increase our liability, we have to credit the specific account that pertains to that payable or that liability. The example of GL accounts for liability account is or are accounts payable. So accounts payable, when you think about accounts payable, think about your vendors or suppliers. So we always use accounts payable when we receive invoices from our suppliers and from our vendors, and when we pay them, or when we record them first because they're not yet paid, we record them as accounts payable. So think about your vendors when it comes to accounts payable. And I also have to stress the fact that when we look at accounts receivable, think about your customers, because anything that goes, the transactions that go into your accounts receivable are generally the amount that you are expecting to receive from your customers because you sold your product, you sold your merchandise, or you sold your services. So accounts receivable, think about customers, whereas accounts payable, think about your vendors or your suppliers, the amount of money that you owe them for the services they rendered to your company or goods that you receive from your vendor. Loans payable, so loans payable, this could be the amount of money that you owe to the bank because maybe you have applied for a loan to help your business. That is recorded as a liability and loans payable. Salaries payable, these are the amounts that you owe your employees for their services. Rent payable, straightforward, what you owe in rent for maybe your warehouse or maybe your office. Taxes payable is what you owe the IRS for any taxes that you recorded as a liability to the IRS. That goes into taxes payable. Next is a stockholders' equity. So what comprise our stockholders' equity? Examples are paid in capital and retained earnings. So in a stockholders' equity, obviously we use that for a corporation, right? But if you're a sole proprietor and you have an initial investment, you have your capital. The first investment that you put into the business is going to be recorded as a capital. Paid in capital is mostly used for corporations, but for sole proprietorship, that's usually just recorded as a capital with the last name or the name of the company or the name of the owner of the business. Retained earnings. So retained earnings is all the earnings that are retained in the business, right? So the company started and there is a capital invested in it. The very first income of the company for the first year, let's say 2021, the books were closed. The very first net income for that year is going to close into retained earnings. So your retained earnings is comprised of all the net income year over year accumulated by the company. All those go into retained earnings. So the formula for retained earnings is for the following year is you're going to have your retained earnings beginning balance. If you generated a net income, then you add it to your retained earnings. If you generated a net loss, then that would be a reduction from your retained earnings. and then that will give you your ending balance of retained earnings. Again, the normal balance for stockholders' equity, such as your paid-in capital or retained earnings, is a credit. So if you keep on generating income year over year, net income year over year, the balance in your retained earnings is going to be a surplus, which is going to be a credit balance. But if you have been ending up with a net loss year over year, then the balance in your retained earnings is going to be a debit, which means you are at a loss year over year, which is not the reason why we're doing business. So, right. So we got to make sure that we make that net income, so our retained earnings will be a positive balance, which is a credit balance. And I have some notes here on the side. I just want to, I know a lot of students, especially those who are just starting in accounting, are always confused about, why do we have GL accounts? What are they? So these are the examples of your GL accounts. I just want to reiterate that. First of all, when we say GL, we keep on saying GL because we already know what it is. That refers to the general ledger. So when we say GL accounts, that refers to the general ledger accounts. So over here, I'm just trying to make it clear that accounts are also called GL code, or simply accounts, or GL accounts. Those are the same thing. Account name or account title. These are used in entering and recording transactions in the general ledger. So these are the accounts that you're going to use when you do your journal entry. So these are the same accounts too that flows through the financial statements, such as the balance sheet or the income statement. We'll move on to our next slide. So now we're going to be discussing about the normal balances of accounts. So this is very important because, like I said earlier, we have to keep on stressing the fact that these are the basics in accounting, and it's very important that students first understand what debits and credits are and what their uses are and what the normal balances are. So this is a very quick overview of the normal balances of the account. So this is in the form of the general ledger, which is a T account, and it's called a T account because obviously the shape is T, right? So on top of the T account, you're going to show the GL number. So in this case, we're just doing a high level review or overview of the normal balances. So you won't see the specific GL account name, but you'll see the categories such as any asset account, expense account, equity and liability account, and any revenue or sales account. Also, when you see a typical T account used for analyzing an account by accountants, you won't see a debit and credit words there. But in here, for purposes of explanation, we have the debit to the left side. Always the debit is on the left side and the credit is on the right side. That is a standard. Now here, for example, if it's an asset account, referring to the first T account, if it's an asset account, like we've seen in our first couple of slides that we had earlier, we have examples of asset accounts such as cash, accounts receivable, inventory, any prepaids, and property, plant, and equipment. So every time we increase our asset account, increase right here, right? We denoted it with an increase. We debit that asset account for our journal entry. Every time we purchase new equipment, we purchase a land, we purchase building, we purchase inventory, it's all going to be debited because we're increasing those assets. We receive cash from our customers, so our cash is going to be increased. So we're also going to debit that cash account. And if they are going to be decreased, if an asset is going to be decreasing because maybe we're decreasing cash because we paid our accounts payable, we paid our bank, we paid our vendors, so that will decrease our cash. So therefore, we'll do the opposite. Instead of debiting, a decrease in cash or any asset account will mean that in our journal entry, we're going to have to credit that GL account. I hope that makes sense. That's our asset account. The expense account, I'm going to go to the expense account. The normal balance of our expense account whenever we are increasing our expense accounts is also a debit. Expense accounts are examples of these, which we have not seen that yet earlier. We only discussed the balance sheet. Expense accounts are recorded in income statement, and examples of that are, let's say, your salaries expense, rent expense, whatever it is that the company is paying. Utilities expense is another example of that. So whenever we're paying those bills for utilities, rent, salaries, and whatever it is that we have, any miscellaneous expenses, we will debit those accounts. We are increasing the balance in the GL account for those expenses, so therefore they have to be debited. If we are decreasing the balance because maybe we receive a credit from our electricity bill, or we receive a credit from our water bill, right? So if we are decreasing it because we receive a credit, then it has to be credited. Any equity and liability account, like we discussed earlier, examples of liabilities: accounts payable, loans payable, salaries payable. If it's a liability and we're increasing the liability, it's going to go to the right side, which is a credit. So in your journal entry, you're going to be crediting accounts payable, you're going to be crediting loans payable, salaries payable. Any kind of payable or liability that your company have will be credited anytime we increase those liabilities. If we are decreasing the liability because we paid our vendors, we paid our accounts payable, right? So that will decrease our liability. So therefore, we're going to have to debit accounts payable. If we paid our bank because we have an existing loan that we previously have credited in loans payable, and now you're paying it, let's say it's a mortgage, right? So you have a balance of, let's say, 300,000 that you credited originally in loans payable account. When you pay the bank, it's going to be the opposite here, right? So this time your payment is going to be a debit to loans payable. I know this probably doesn't make sense right now, but once we do our examples, which is not going to be in this video, in the next video, video 3, we're going to have an example. It's going to be a full-blown process of accounting, from identifying the transactions to recording them to seeing them in the financial statements. You're also going to create, we're going to present some journal entries as well in video number 3. This is all going to make sense once we have that example. Now, any revenue account, so you generated sales, you sold your merchandise, you sold your services, therefore you're increasing your sales, right? So that will go to the revenue or sales account. You increase it, so therefore you credit that account. So let's say, for example, you sold $100 worth of merchandise, and you sold it for $100, but there's also a specific cost associated with that. But right now, we're only going to talk about what are you going to do with inventory, because that came from your inventory. You sold your inventory for $100. So if you sold your inventory for $100, that $100 is going to be credited as sales revenue on the right side of the T account. The normal balance for a revenue is a credit, so every time you made sales, you're increasing your sales, you're always going to be crediting your sales account, okay? And if it decreases, because, and that's another story too, generally we don't want to record anything on our sales revenue account that will decrease it for returns. There's another GL that should be used for sales returns and allowances, and that's what we call a contra revenue account, which doesn't go to the sales revenue account, and that's going to be another topic that we can do later on. So for now, let's just focus on the normal balances overview. So remember this, when you try to create your journal entry, this is going to be very helpful. So yes, so I recommend that you keep a tab on this. So whenever you have an assignment where you have to create a journal entry, just remember this quick overview, and it should help you a lot. Okay, so why is it important to understand the normal balances of GL accounts? And I think we've already answered that question, but here is the answer here. So it helps in determining whether to debit or credit an account during the journal entry posting or the process of journal entry. It's important to remember what to do when a transaction or activity causes an increase. So like I said earlier, when you want to know what the normal balance of an account is, think about an increase. Whenever you increase the account, what do you do? Like say, I said earlier, when you increase an asset account, you have to debit that asset account. When you increase a liability account, you have to debit or credit, sorry. When you increase a liability account, you have to credit that liability account. Once you understand the effect of increases, then the rest is the opposite. Use the above quick overview table as your reference when you create a journal entry. Okay, so we're gonna move on to the previous slide was more of an overview. So this time we're gonna do a more detailed version. So this time we have the normal balances in GL account level for balance sheet accounts. So you can see here the accounting equation, right? You've got the assets, which should be equal to the total of your liabilities and stockholders' equity. So on the right side, we've got the liabilities. If you add both liabilities and stockholders' equity, the total of that should equal the total of the assets. So that's our accounting equation. So in here, we've got it up detailed by different kinds of GL accounts or GL account names. So under assets, like we said earlier, the example accounts for asset are cash, accounts receivable, inventory, prepaid expense and other assets, property, plant, and equipment. So these are just examples. We have a ton of asset accounts. We have a ton of different kinds of GL accounts that we're using. But for simplicity, so that it'll be easier, a little easier to understand, we only included here the most popular accounts that we have. And based on that, you can see here earlier, in our slide earlier, we only did an overview where you have the normal balances of the accounts based on the account category. So this time what we have is, here's the account category, it's an asset, and here's the different kinds of GL accounts that pertain to it, and here's what the normal balance is here. So when you decrease or when you increase, we debit cash. Decreasing cash means we credit cash. Liabilities, we have the same thing. We have accounts payable and other liabilities. The normal balance for liability is credit. So every time we increase liability, accounts payable and other liabilities, we have to credit that account. Every time we decrease, it'll be the opposite. It'll be debited. On our stockholders' equity, we have paid-in capital and retained earnings with normal balance. Every time we increase paid-in capital and retained earnings, we have to credit the accounts. And if it's the opposite, because maybe we generated loss on our net income, so therefore our retained earnings now is becoming a negative balance. If that's what's happening, if year over year the company is generating net loss, there will come a time when the retained earnings balance is going to be a negative balance or a debit balance. But that's not what we want. We want to be here. We want to be on the credit side because that's when we're generating a net income. Okay, so hope this is very helpful. Important note here, each account balance footed must allow the normal balance rule, or must follow the normal balance rule. So when I use the word footed, it means that because in our general ledger, the T accounts are footed. We call it footing. So you take the difference between the debit and the credit, and then like say for example, if it's cash, the normal balance is a debit. So therefore, when you add the debits and the credits, the debit should be higher than your credit, and therefore you're going to add the total or the balance of the account, the net balance of the account, under the debit balance. So if you have a total credit of $1,000, and if you have a total debit of $1,500, your $1,500 debit is higher than 1,000, right? And that's normal because the normal balance of the cash account is a debit balance. So therefore, the debit balance should be higher than your credit. So that means $1,500 debit minus the $1,000 credit will give you a footing at the bottom, a debit balance of $500. So that's how this T account works. So you've got those net balance, you have debits, credit, because this is where all the transactions are recorded. So if you first recorded cash, right, every single collection from your customer will be debited here as an increase in cash. And then every single payment that you made all throughout the month, payment to your creditors, will be credited here. And then at the end of the month, you're going to take the difference of your debit minus your credit in your cash account, and that should give you a positive balance. And when we say positive balance, that means that you are within the normal balance rule for the account. So like my example, it's $1,500 debit total, $1,000 credit will give you a net balance of a debit of $500, which is good because that means that you are in a positive cash position, right? So you don't want this to be a credit balance, especially cash could never be a credit balance. If your cash account is a credit balance, then there's something wrong. So that should trigger some kind of researching. So I have a note in here too. So when we refer to a negative balance, I say, for example, if your accounts receivable becomes a negative balance, meaning that the balance of your credit, since the normal balance for accounts receivable is a debit, right? If you have a negative balance, which means you have a credit balance in accounts receivable, then there must be something wrong. So it's either somebody overpaid you, your customer must have overpaid you, right? So it can never be a credit balance. So if it's credit balance, that should trigger an analysis and a research. And whatever that credit balance is should then be reclassed to a liability account. It could be an accounts payable, it could be other liabilities, depending on what the reason was why there was a credit balance in accounts receivable. And vice versa, if your accounts payable has a negative balance, meaning it's a debit balance because the normal balance of accounts payable is credit, right? So it's not good if accounts payable at the end of a period becomes a debit balance. That's not good. So that should also trigger an analysis of accounts payable and try to figure out what caused your accounts payable to have a negative balance or a debit balance, because that will mean now that you no longer owe your vendor or you no longer owe your supplier if this is a debit balance or a negative balance. Then you'll have to check your invoices. Did we overpay them? What happened, right? So if that was the case, then you'll have to ask your suppliers for a refund if that was the case. But that could be a possibility as to why your accounts payable will have a negative balance or a debit balance. So again, normal balances should always follow, right? Liability should always be a credit balance. The stockholders' equity should always be a credit balance as well. Your assets, right, should always be a debit balance. So if you can notice it here now, your assets should always be equal to your liabilities plus your stockholders' equity. Your liabilities and stockholders' equity are all credit balances, normal balance, while your assets should always be a debit balance. Okay, hope that makes sense. And now we're going to move on to income statement. So that was balance sheet that we just discussed in our previous slide. So the income statement is always going to be your sales less the expenses, and that will give you the net income. And that's the net income that flow through the retained earnings that we discussed earlier for our balance sheet. So this is where we're saying that your sales minus all of your expenses should always be a net credit balance, right? Because sales has a normal balance of credit. Any increase in sales, because you continue to generate sales, that should be credited to your general ledger account sales. And then any expenses paid, we have to debit. Increasing your expenses means that you have to debit these accounts when you create the journal entry. Cost of goods sold, this is another form of an expense, but it's a cost. It's directly related to the cost of your product, cost of goods sold. Whereas in here we have your selling and general administrative expenses, and that includes rent and insurance expense and depreciation expense and other kinds of expenses, including utility expenses, should fall under your SG&A or selling and administrative expenses. Okay, so again, just want to reiterate here that your net income is calculated by taking your sales total right here. Sales less expenses is equal to your net income. So similar to our balance sheet, this should also must follow the principle of the normal balances. So there's a note here too that sales or any revenue accounts normal balance is credit. Generating sales increase the sales revenue account. Therefore, the journal entry must be credited to sales or sales revenue. Any expense account, including cost of goods sold, normal balance is debited. This means when accounts payable AP department pays an invoice for an expense such as utilities or rent, the appropriate expense GL account must be debited. If a credit was received from the vendor, this transaction will decrease the expense, and therefore expense must be credited. Okay? So that's the end of our PowerPoint presentation. I hope everything makes sense. If you have any question, any comments, feel free to make your comment if you have any question. I'll try to answer them as I see those questions. So this is the end of our video number 2 lecture. Please check back for video number 3, where we're going to be applying what we learned from video number 1 to video number 2. We're going to be using a simple exercise. In video number 3, we're going to be creating a journal entry. That's our JE. GJ is general journal, GL is general ledger, TB is the trial balance, BS is the balance sheet, and IS is the income statement. And yes, we are including financial statements in video number 3. So again, please keep an eye on video number 3. I think that will be very useful because we are going to be using what we learned from video number 1 and video number 2. And that will be a great exercise. So please stay tuned for video number 3. Again, explore, learn, and win. And subscribe, like, and share if you like these lectures that I have in here. Learning is a journey. Celebrate your successes, learn from failures, and keep that faith that you'll get your goal soon enough with persistence and determination. This is ENA's Excel and Accounting, and thank you very much everyone for watching. Take care.